Hi, this is Francesco Nagari, Deloitte Global IFRS Insurance Leader. Welcome to our first 2020 IFRS 17 webcast, and Happy New Year to you all. Today's webcast is titled Reinsurance Accounting for Cedents has been improved. And the title has been chosen because the ISB has already held its first meeting. It was the last in 2019 to approve the amendments to IFRS 17, which will be published later on in 2020. Two more rounds are planned. One is going to be this month in January, and then a final one in February, based on the current plans. But before I dive into the details, let me just remind you of the agenda that I prepared for you today. We'll start with the highlights in a moment. The meeting was held on the 11th of December 2019. And then we'll spend the majority of the time of today's webcast, which is going to last just under 40 minutes, to look at the discussions and the details that were presented by the ISB staff and the ISB comments on that and the decisions that were reached. We'll also spend a few minutes at the end to talk about the next steps after the December meeting. In terms of the highlights, everything that was tabled for approval has been approved unanimously. That is an important comment I wanted to make in the opening session today, because it is indicative of the tone and the pace that the ISB appears to be taking in dealing with the amendments to IFRS 17. Two substantive items for discussions, as I said, both approved unanimously. The first one is the amendment of IFRS 17 to improve the accounting of distribution cost, which the standard calls insurance acquisition cash flows. There's been a number of confirmations as to how to recognize the asset for pre-coverage acquisition costs. Also, decisions on the unit of account being the group of insurance contracts. Additional guidance has been approved on the recoverability of these assets by effectively carrying out the two-step impairment test that was already in the exposure draft, but is now being detailed in the context of the new decision for the unit of account. And then also a number of decisions on presentation in the balance sheet to be part of the same line item as the insurance contracts liability or asset and disclosure. The biggest positive news, in my personal opinion, is on the second substantive discussion item for the December meeting, which is the reinsurance contracts held. The recovery of losses from these contracts is now going to be extended in terms of the new proposed amendment to all types of insurance or reinsurance contracts. This is a great outcome, in my opinion. It is also what Deloitte strongly recommended in our comment letter, and so we are, of course, delighted to see that the ISB has taken that recommendation into account. We've also we will explain later that there is now also a new calculation that the ISB will introduce in IFRS 17 for this reinsurance credit, which is the focus on the P&L. And so the P&L effect is going to be the driver based on the percentage of recovery from the reinsurance contracts held. The third part of the meeting in December was to deal with a number, actually, 6 individual amendments which were approved without substantive discussion because the volume of comments received for those 6 items was very positive, and the staff felt that only a limited amount of discussion was sufficient to conclude on the inclusion of the items into the future text of IFRS 17. That doesn't mean that they're not important. Actually, they are very important, and when we get there, I will explain to you what these 6 items are and which ones, in my opinion at least, are particularly important for your implementation journeys. But let's now dive into the first of the 2 substantive discussion items. The first one is the one on the pre-coverage assets. And so you know that this was responding to one of the good outcomes from the TRG activity that I've been conducting together with the other TRG members during the course of 2018 and 19. And in particular, the recognition that there are commission-based payments that insurance companies pay to their distribution partners, which are not necessarily attributable to the contract that has been secure with the payment of that commission. Those payments, they are made and calculated in the anticipation of renewals of that first contract with what effectively is a new customer for the insurance company. And so the amendment was introduced in the ED to allow the deferral and capitalization of those additional acquisition costs. IFRS 17 already had some pre-coverage asset guidance, but what this has triggered is actually a refinement of the entire regime surrounding the accounting of these pre-coverage assets, which is now, I think, comprehensive enough. There are still some area for improvement, and I'll tell you later what are those, and in particular one that we at Deloitte believe is very, very important. But as far as the decision that the SB reached in December, they agreed to finalize the amendments, and effectively, so we're going to have these assets becoming bigger, and that additional piece of cost that they're going to be deferred in this pre-coverage asset will be allocated to future groups that include contracts that are expected to arise from the renewals of these new customer that buys the first contract with the company. The board in the papers that they approved also clarified that this allocation to a group of insurance contracts cannot be treated as a separate asset again. So once the allocation is done, it is irrevocable and it cannot be taken out of that allocated group of contracts to be allocated to another one in the future. And finally, they also clarified that these assets will be presented in the balance sheet together with the insurance contracts assets or insurance contract liabilities as a deduction from the liability amount, and not as a separate line item on the balance sheet. So maintaining effectively the very high simplified balance sheet presentation structure that IFRS 17 introduces from the plethora of balances that you have under IFRS 4. The SB also agreed to finalize the disclosure requirements. These are perhaps an important implementation point from a data perspective. There will be a requirement to have a reconciliation. Effectively, you can put it as an additional table in your roll forward table for insurance contracts, showing opening and closing balance, as well as the allocation to a group of contracts, impairment losses, and reversal of impairment losses, if any. There will also be an additional table to be produced, which will show how the carrying amount of these pre-coverage assets will be allocated to future groups, and this table will effectively be presenting columns that are designed to be appropriate time bands, showing at the time of the balance sheet in which the asset is reported when and by how much the asset will actually go down to zero, given the assumptions for future allocations that the insurance company will have. There are also transition relief discussion points associated with this topic, but they are not going to be included in the papers that the ISB approved last month. Instead, we're going to go either this month or next month in a comprehensive transition relief package paper that will deal with transition probably across the board. One area where I want to spend a little bit more time is the impairment test and the unit of account, because these two are the components of the new measurement regime that have received a greater level of discussion during the course of the meeting last month. You know that the standard exposure draft already came out with the idea of a two-step impairment test. An impairment test that is done at the level of a group of insurance contracts, which is the group level impairment test, where an impairment loss is recognized if the carrying amount for the pre-coverage asset is lower than the expected net cash inflows of the group. And then an additional impairment test, which is specific to this new additional asset component dependent on future renewals. Some respondents suggested that the ISB suggests what is the unit of account for this asset, and the decision is the unit of account for an asset for acquisition cost is the group of contracts to which those cash flows have been allocated. Now, this creates a degree of ambiguity, in my personal opinion. I'll explain later what is the impact of that potential ambiguity on the impairment test. But let me tell you first that the test then works along the lines that I hopefully described clearly in this slide. You can see that we look at this asset as a composition of two pieces. An old piece, which comes from the original text of IFRS 17. This will include effectively the non-commission-based acquisition costs that were paid before the date of issue of group of insurance contracts. And then there is another portion that is the new asset component, which comes from the multi-year commissions discussed back in the February 2018 TRG, when at the time we were concluding as a TRG together with the staff and the board members present that they would have to be reported in the first group that contains the first contract only. Now we know that a significant portion of those commissions can actually be deferred and added to the pre-coverage asset for allocation to future groups as they are issued. The test on the total asset works against the net inflows expected to arise in the future over the period that will be used by the insurance company to allocate the total asset. And so this first recoverable amount that I call A is used to test the total asset. So if that recoverable amount is lower than the total asset, then you have the first slice of impairment loss coming in, or not. The recoverable amount in this case could be larger than the total asset, in which case, even if the facts and circumstances have led you to the calculation, you don't need to book any impairment loss as a result of the step 1 test. But that's not the end of it. You need to do the step 2, and that is focused specifically on the new asset component that comes from the commissions, where you need to test that portion of the asset against the renewals that will arise from the group of contracts that has effectively been generated by the commission in the first place. Remember that this commission effectively brings a new customer into the in-force portfolio of the insurance company, and the question then that amount B is trying to answer is whether the expectation of renewals that come from that one new customer, together with all the others in the same portfolio for the same group, is going to be covered by the future net inflows arising from renewals only. And so this is a more biting impairment test than the amount A, and the paper of the ISB staff explains that you then have a possibility for a second chunk of the loss, or if the first test was positive, was negative, and you had no loss, you may end up having a loss from the second step test. Now this is where the unit of account starts to play a role, because we think at Deloitte, at least, it is plausible to read the staff paper as going in two possible directions. One, we would actually we would not favor it, and the other one we would favor it. And the one we wouldn't favor is that the unit of account is effectively applied prospectively, and the group as the unit of account for impairment testing would effectively be interpreted as calling out for the slices of the pre-coverage assets based on the expected allocation to future groups. And so you will see then the total asset is sliced up by year of expected group emergence, and then you carry out the two steps impairment calculation group by group if the facts and circumstances determine that to be necessary. We hope that is not the case, and that when the standard is published, or we see the near final draft text, we have actually what this was meant is a portfolio-based unit of account that looks at the asset for the portfolio that contains the future groups. A group cannot be straddling across portfolios, and so we believe that that's what is really intended. Because in that case, then the two sections that I talked about earlier will actually work fine, and I think that it is a reasonable and practicable implementation requirement to add to the work that all of you will have done already by now. We'll see in the final text whether this is indeed the case. We really hope so, and we'll do our best in our private conversation with the ISB staff to check out that this is the direction that hopefully they're going to be taking. The last point I want to mention with regards to the pre-coverage asset is a point that we made in our comment letter, which you see quoted at the top of the slide, with regards to the guidance necessary to reflect time value of money in the calculation of the recoverable amount for these impairment tests. We felt that the exposure draft didn't have any guidance on the time value of money, and that omission was concerning us. We felt that that was limiting the transparency of the impairment calculations and also diluting the possibility of a consistent application of the principles. And here you can see an example as to why we think that matters so much, because we know already from our own clients that these assets will be allocated over a long period of time. Here I just illustrated an allocation over the next 2 years from the date in the year in which they are paid, but we have seen clients with 8-9 years of expected allocation periods. And so over that period of time, you need to be effectively sure that you're reflecting the time value of money in the most appropriate manner. We believe that the reference to the existing guidance in the standard is the right way to go. And what we will say is that the guidance should just say, use a contemporary yield curve at the time you are trying to estimate the expected net inflows from those future contracts. And so that means that if I got 2 years of expected net inflows, I will use a curve that actually starts in T2 and T3 with the lower part of the curve applied for the beginning of the net inflows coming in and so on, rather than riding the later portion of the yield curve that applies to the reporting date in which the asset is booked. Because that means effectively using, given the convexity of yield curves, a higher discount rate. And that is effectively, in our opinion, unfairly depleting the net recoverable amount that would then be used for calculating the impairment loss. Once those dark blue boxes in T2 and T3 are calculated, then we would suggest that there was another piece of guidance to say those net inflows will have to be discounted based on the current measure of time value of money at the reporting date associated with the portfolio of contracts from which future groups will emerge. And so in that instance, then you discount T2 and T3 with the discount rate that lands on the equivalent T2 and T3 portion of the yield curve at reporting date T1. And in this instance, you then determine the present value of those two amounts, showing the recoverable amount being the sum of the two. And in this illustration, no impairment loss arises. I didn't go through the extent of splitting up the two tests, given that from a time value of money perspective, there is no point in illustrating that matter. But in here, you can see that in that illustration, the recoverable amount is still greater than the carrying amount of the asset, and so no impairment loss is booked in the financial statements. We'll tell again privately the SB that we still think that is an important point, but obviously the direction is that this recommendation from Deloitte is not taken into account at present, and the likelihood of the standard coming out without that guidance is more likely than not. So then let's move to the second item of substantive discussion in the December meeting. That's the one where I personally believe that there are some really good news for everyone. The accounting for reinsurance contracts held in terms of recognizing in P&L the recovery of losses for underlying onerous loss-making group of contracts has been improved. And the key improvement is that as recommended in the Deloitte comment letter, the ISB has now abandoned the bright line that separated the insurance contracts held between those that could generate a credit at the initial recognition of the onerous loss and those that could not. That is gone. So now we have a significant extension of the scope of the proposed amendment. So all types of reinsurance contracts are now going to be accounted for in the same way, which is great news. And also, there is going to be an amended proposed calculation, which the board approved unanimously, using a percentage of recognized losses as they're going to be recognized from the as they're going to be recovered from the reinsurance contract. I'll explain about the calculation, which is the really important new piece in a moment in more detail by showing you some examples. But before I do that, a few other ancillary decisions also unanimously approved. Because of the removal of the bright line on the proportionate coverage, the board approved to remove the footnote to paragraph BC 304, which was drafted to explain the proportionate coverage notion and to allow effectively non-binding guidance to be present in the standard to ensure a proper application of that concept. Given the concept is now gone, as far as the measurement is concerned, we don't need that anymore. The ISB has also confirmed that this amendment applies only when the reinsurance contract is recognized before or at the same time as the loss is recognized on the underlying insurance contracts, which is very sensible. And they also clarify that the paragraph with all the amendments will also apply to a group of underlying insurance contracts that becomes onerous, but it is measured using the premium allocation approach. So again, that's another good clarification. As I said, let's have a look at the proposed calculation. And let me start by showing you the example 1 in staff paper, agenda paper 2C. That's the one that effectively already came from the exposure draft with the proportionate coverage. It's just important for me to show you the before and after amendment. So on the left-hand side is before amendment. You can see recognition is a different timing, and that creates an accounting mismatch. With the amendment for proportional coverage, we were going to align the P&L to effectively mitigate the onerous loss of 50 by the 20 credit receivable from the reinsurance contract. The one example that I find most compelling for the webcast today is example 3. Here you see two interesting characteristics which illustrate the new calculation. The first one is that the premium payable to the reinsurer are non-proportionate, but the recovery still remains proportionate. It's still 40% of the losses. And the second thing is that the reinsurance contract held as a result of those premiums and recoveries expected is in a net cost position. So that means that you are effectively recognizing a CSM in the insurance balance, which is an asset. If we were leaving IFRS 17 as it was before the ED, you would have had the 50 onerous loss and the deferral of 5 happening at different time. With the exposure draft and the decision to abandon the proportionate coverage, now we have the good news here of what I call a P&L driven calculation. So you can see here that what the ISB wants now is to take the loss, apply the 40%, so that gives you the proportion. The percentage is 40% here. It gives us a credit of 20 in the P&L, and that's what we're booking. The interesting thing happening here, which I'll talk in a moment also about concerns around it, is the fact that your CSM asset in the insurance balance in the balance sheet goes up from 5 to 25. And so this means that there is now a deferral net cost of 25 currency units that will be recognized over the coverage period of the insurance treaty that you have purchased. And this effectively represents the right to recover the 20 of the 50 expected loss, the right to recover 40 of the 100 expected claims in addition to the expected loss, and the right to recover amounts relating to any unexpected claims. In addition, this could also relate to the recovery of expenses other than claims that may be included in the treaty. Now that is, in my opinion, a fair way of representing the accounting. I don't think that there is any concern in increasing the CSM asset in this particular instance, because what is the most important thing, in my opinion, is to reflect correctly the net profit or loss after reinsurance in the period in which the onerous loss is reported. Some respondents were concerned that this deferred loss effectively was going up as a result of a credit, and they felt it was necessary for the ISB to consider that carefully. The ISB staff produced another example where they said, let's assume that we have 100% reinsurance and we have premiums of 280, an expectation of claims of 300, that creates a onerous loss of 20. Because we got 100% reinsurance, we end up having a reinsurance premium of 300 currency units. Now, in this example, if claims occur as expected, the insurance contract has no overall effect on the net cash flows. With or without the insurance contract, the entity has still a net cash outflow of 20 currency units. However, with the amendment, the entity would recognize a loss recovery of 20. At the same time, it recognized the loss of 20 and a net cost of 20 in the CSM reinsurance amount to be recognized over time. Now, this would show that that benefit, the recovery when the loss has a reason from the underlying contracts, is then consumed and therefore amortized over the period that is there, also to protect for more losses emerging as a result. Now, the ISB staff has also said that the proposed amendment would only apply when the insurance contract is recognized before or at the same time as the loss is recognized from the underlying contracts, and that this requirement, in addition to the requirement to disclose the loss component of the loss recovery amount, should be sufficient to limit any possibility of abuse. And I tend to agree with that conclusion. So in consideration of all these arguments, the staff concluded that they believe that this loss recovery calculation will still fully address the stakeholder concerns about the accounting mismatch, be operationally simple, and provide comparable, transparent, and useful information to the users of financial statements. And the ISB decision, as I mentioned in the highlights, was again unanimous to amend the calculation, to amend the standard to the draft standard, and remove the restriction from the proportionate coverage that was originally included, and effectively to confirm that the loss recovered from our insurance contracts held will be calculated by multiplying the loss recognized on the underlying insurance contracts and the percentage of claims on underlying insurance contracts that the entity expects to recover from their insurance contract held. Let me now move to the third part of the ISB meeting in December. That is the other amendments which the board in November approved would not require substantive discussion. And so they all lumped together into one paper. And there are 6 of them. But let me just go through them, because here is where I'm going to tell you that despite not requiring substantive discussion for their approval, again granted unanimously, some of them are very material implementation changes in IFRS 17. Starting from the first one, indeed, where we're going to have now confirmed that the IFRS 17 requirements for earning CSM from insurance contracts with with direct participating features, the VFA, effectively subset of insurance contracts, must include in the calculation of coverage units also the attributable investment services. And that is a fundamental change in the way the profit signatures for those contracts will emerge under IFRS 17. The second one is important, particularly for the general insurance sector, effectively elevating the level of aggregation of presentation for the balance sheet from group to portfolio. And that is something that should help general insurance companies to manage their working capital cycle within IFRS 17 in a less burdensome way than it was if they were required to present balance sheet at the group level. Transition relief was introduced for liability for incurred claims, which have been acquired in a business combination that occurred during a prior period when it is impracticable to do a full restatement. In that instance, you don't need to account for that liability for incurred claims that is acquired as a liability for remaining coverage with a CSM. Instead, you can continue to present it as a liability for incurred claims, and the difference that would have gone to CSM in a normal accounting for full restatement or going forward is taken to an adjustment of net earnings on transition date. They also approved the exclusion for loans that meet the definition of an insurance contract, not a significant implementation for the insurance sector, but certainly a useful relief for other financial institutions that may have developed loan type insurance contracts, and that will be the only insurance contract type in their product portfolio. A couple of risk mitigation options. These are important, actually. The first one is a good concession. The first part of it is the fact that the restatement can be done for the comparative period, of the first set of financial statements under IFRS 17, not just for the current period. So if it is 2022, the restatement will be 21. You can restate the hedge accounting for VFA if you can prove to your auditors that this was in place as of the 1st of January 2021. The second part of this amendment is actually even more important because it does eliminate a substantial accounting mismatch that would otherwise exist in the opening balance sheet on the 1st of January 2021, because it allows you to effectively apply the fair value approach on that date, even if you could do the full restatement. And that is because the SB was not comfortable to allow a retrospective restatement of the hedging relationship. So they found what I think is a quite intelligent way of dealing with the problem at transition date. The second risk mitigation option amendment that was approved is the approval to use reinsurance contracts held as hedging instruments. And that is something that is actually quite impactful on implementation efforts. And let me tell you a little bit more about it. As you know, there is a desire from a number of stakeholders to see reinsurance as counted for hedging management purposes. And so that is actually something that we said in our letter we do not disagree with. However, although we agree with intent, we believe that there was a better solution. Unfortunately, this will be the last time I talk about it because it has not been taken up. And the better solution would have been effectively to allow those reinsurance contracts to be accounted for as contracts under the variable fee approach. Instead, the restriction of all types of reinsurance, whether it's held or issued, from being accounted for under the variable fee approach remains in place. And cedents will have to work out the implementation process to separate the changes in cash flows from their reinsurance contracts that are designated to be hedging items, so hedging instruments, I beg your pardon, for VFA portfolios, which are the hedging items, between the non-financial risk, which remains part of the CSM unlocking, and financial risk variables, which instead will have to be accounted for through P&L in totality, in the same way as that split will have to be done for the VFA hedged item. If this was done through a VFA accounting, we think the split would not be necessary, and it would be effectively making the reinsurance contract held a virtual underlying item to be added to the other underlying items and work through the accounting under the VFA. But our idea has not been met by the consensus at the ISB level. Coming then to my last slide for today's webcast, the next steps. As I mentioned at the beginning in the highlights, we have 2 more meetings, one this month, in the very last week of January, and the other one in February. There are a number of remaining topics, so we have just packaged them together. It comes out to about 9, the way we count them. Scope of exclusion for credit cards. The other change in the CSM attribution, this is the one for the contracts that we used to call indirect par colloquially, and the introduction of the definition of an investment return service. Another risk mitigation topic, this is as to why not allowing also non-derivative financial instruments at fair to P&L, like bonds, to be hedging instruments. The same hedge accounting under VFA continues also in number 4 with the discussion and approval as to why not allow the risk mitigation option to be restated retrospectively. And then the one item that everyone talks about it in the IFRS 17 small world, the effective date of IFRS 17 and the parallel impact on the deferral of IFRS 9 temporary exemption for insurance companies. Number 5 is the one that we know based on conversation during the board meeting in December and the staff paper that is unlikely to be included in the agenda this month. The paper should be coming out in a few days' time, so we'll know for sure, certainly by the weekend. But we expect, given what has been said and written, that effective dates will be debated and voted in the February meeting. The other 4 items are non-exposure draft related items, so they are effectively new topics that, as a result of the volume of comments around them, the ISB agreed to a table for discussion. Number 6 is perhaps the most important one, level of aggregation for those specific insurance contracts that have characteristics that are often referred to as the mutualized characteristics. And in that context, there will be a discussion around the use or not of annual cohorts for the measurement of those contracts. Then, going back to the business combination point for liabilities for incurred claims, this is going to be another topic for discussion for those liability for incurred claims acquired in the period where full restatement is possible and going forward. So the whole thing, and as to whether those should indeed be reported as liability for remaining coverage as currently presented in the standard or not. Number 8 is a point regarding interim financial statements. Paragraph B 137 mandates a departure from IAS 34, which a number of stakeholders have commented is quite onerous, and the board has agreed to discuss as to whether they should retain that requirement or reverse back to the IAS 34 accounting as normal, which means rolling forward the interim period on the annual basis when the annual financial statements are prepared. Last is a package of additional specific transition modifications and reliefs, including the transition requirements for the pre-coverage asset that I mentioned earlier. The staff noted that the 2 meetings coming up should be sufficient to conclude on all these remaining topics, and that would then allow them to start drafting the text of the revised IFRS 17 standard, and the ballot process to be completed well within the first half of 2020. At that point, obviously, the ball goes back into the court of all the national standard setters around the world responsible for the endorsement of IFRS 17 in their respective jurisdiction. And in that regard, I'd just like to mention to the participants in the webcast that is favorable to the European Union subscribers of our webcast that that is actually the critical contention at the moment, because you may know the letter of the European Financial Reporting Advisory Group indicated a preference for a 1 January 2023 effective date, which is 1 year later than the intended revised effective date proposed by the ISB. A number of other national standard setters from other jurisdictions have commented to say that they are okay with 22. So we have a very much of a split between stakeholders. It seems from the staff paper that the majority, a slight majority, is in favor of 22, and a lot of preparers are in the other camp, including a body as reputable and respectable as EFRAG. And so given that the other camp is asking for a global timetable above anything else, I think that it will be an interesting discussion and an even more interesting vote on the matter of the effective date that is coming up next month. Deloitte will follow both board meetings for you, and you should have already a date saved in your diary for the next 2 webcasts that I will be producing to report back to you on the outcomes of the January and February ISB meeting on IFRS 17. That is the last of my comments for today. So as I land on the last page of the deck, I'd like to invite Michelle to stop the recording.